Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Charlie Pellet. Doug Krisner's off this week. The S&P 500 was on the brink of all-time highs in the Tuesday session before losing steam. Coming up, we'll get a look at markets from the APAC perspective when we hear from Vishnu Varathan, the head of economics and strategy at Mizuho Bank. But we begin with trade. President Trump says tariffs on semiconductor and pharmaceutical imports will be announced within the next week or so. Trump added that he was getting very close to a deal with China to extend a trade truce between the two countries. For more, we heard from Bloomberg News Desk Editor Jill Disis. She spoke with Bloomberg's Heidi Stroud-Watts.
Let's start off with the pharma threat. He said it'll start off small, but then potentially 150, 250%.
Yeah, I mean, Heidi, I think at this point, this is just the latest in this round of sectoral tariffs that we're really expecting from Trump. In addition to pharmaceutical goods, he's also talked about tariffs on, chips, semiconductor components, that kind of thing. That I think he's still a little bit fuzzy on what exactly those numbers would look like. Obviously, we do have to emphasize this is Trump. A lot of this, has the tendency to kind of change and sort of shift over time. I think at this stage, when it comes to some of those pharmaceutical tariffs that he's talking about, it's really just about seeing what that initial number is and then how much he actually sticks to this idea of hiking rates. I mean, 150%, 250%. We're talking incredibly high tariff rates that could potentially be facing this industry. Very, very industry disrupting. But the one thing that I do also want to emphasize with some of these tariffs that he's talking about, these sectoral tariffs, so the pharmaceutical ones, what he's talked about on chips is that, a big difference between this and then, say, these other reciprocal tariffs that he's, been, handing down country by country is that these sectoral tariffs are something that, comes out of a Commerce Department investigation, and they're actually much more difficult to roll back, once they're in place. So I do think that's one thing that maybe you're looking at in terms of market reaction. But yeah, I mean, again, a lot of uncertainty about this, but that's, often the case when it comes to Trump.
And uncertainty as to what we're saying with China, but it all kind of sounds like the mood music is positive on, pushing back this deadline, really.
Yeah, so that's the 90-day reprieve that we've got from those incredibly high China tariffs. It does seem like they're pretty well situated to push that maybe another, 90 days or so. So that deadline for that reprieve is supposed to expire on August 12th. So, getting into next week there. I think, when it comes to China, really, the big sort of looming thing in the background is this idea that there could potentially be a meeting between President Trump and Chinese President Xi Jinping later this year. Maybe in Seoul during an APEC summit is a good opportunity to make that happen. Trump did say overnight that, he's not necessarily focused on, wanting to have that kind of meeting. He said, essentially, if it happens, it happens. If it doesn't, it doesn't. But I do think that at least in the broader context of U.S.-China relations is one thing that, maybe is, kind of that impetus for, having that meeting. Although, I would point out that as part of Trump's larger, sort of campaign to try to pressure Putin into ending Russia's war in Ukraine, he's really kind of targeted the potential for higher tariffs on nations that sell oil that buy oil from Russia. Obviously India being the primary target, but China is also a pretty significant buyer of Russian oil. So not sure how much that might sort of put a wrinkle in some of these talks about a potential truce there.
Yeah, it's really interesting to see if that approach is going to differ when it comes to how they approach that with Beijing versus New Delhi, right? Because they seem to be sticking to a hard line with India.
Yeah, that's right. It's actually really interesting to see sort of those parallels there because, while, obviously we've just had this discussion about a potential pause and, further truce with these China tariffs. India, was slapped with a 25% tariff, last week, going into effect later this week. And it's really, Trump has really seized on that idea of India as a buyer of Russian oil as a significant reason for that. And then obviously we've talked about these threats. He's threatening to, impose even higher tariffs, talking about that oil specifically. I mean, India obviously has made great strides trying to get lower rates. They were really one of the first out of the gate earlier this year when they were trying to negotiate fairly low rates from the Trump administration. Obviously, that hasn't panned out, and they really have become, sort of this collateral damage in Trump's ultimate push to try to put pressure on Putin. Where we kind of go from here, we'll have to see whether India is successful in negotiating there. But yeah, I mean, at this point, mood music not very positive at the moment, and we're still kind of waiting to see what exactly Trump's threats of higher tariffs that could impact India will ultimately look like.
Bloomberg News Desk Editor Jill Disis there.
Welcome back to the Daybreak Asia podcast. I'm Charlie Paladin for Doug Krisner this week. U.S. stocks faltered Tuesday after weakening services data fueled uncertainty about the Federal Reserve's policy path. The pullback highlights investor anxiety over the Fed's next move. And for a closer look, we heard from Vishnu Varathan, the head of economics and strategy at Mizuho Bank. He spoke with Bloomberg's Heidi Stroud-Watts and Haslinda Amin.
Vishnu, good to have you with us. When you take a look at the data, increasingly you get a sense that perhaps there's a shift in the U.S. economy. First, it was the labor data. We could expect it now. It's services. Is there a sense things have changed?
Well, I think we always took a view that, the household cash flows were tightening up. So as a result of that, you were going to get softer outlook coming through. And I think with the corporates as well, our sense was that the hiring intent was somehow less aggressive at the very least. And now it's turned cautious, which is why sometimes you get numbers that suggest that hours being worked are longer, but that may be getting more out of what you have rather than hiring more. So yes, there is a softening in the data, but there are two fair warnings here. One is there's a lot of distortions due to the tariffs, anticipation of which means corporate behavior is different, front-loading, so on and so forth. Consumer behavior could also be different insofar that consumers who are watching these headlines, it's hard not to look at the elephant in the room, might front-load some spending saying, I'd much rather take on inventory that is not tariffed yet than take on the cost later. So the data would be bumpy. And the second layer of uncertainty is, but it still doesn't take away the problem that simultaneously you could have a price shock. And then you end up with the Fed that still sits on a sharper dilemma, but a dilemma nonetheless. So it doesn't distract from the Fed's dilemma, but it does point to the fact that we probably need to, actively look at two-sided risks rather than just focus on prices alone.
So data is weakening, and that's even before you factor in the impact of tariffs, which will come, Powell says, at the end of the year. So Powell could be wrong. He could be too late in the game.
I'm glad
Trump could be right.
I'm glad you brought that up, Haslinda, because to your point, the tariff effect will come through later. But the real question around that is that durably inflationary, or is it actually ultimately deflationary because the consumer ends up having to dish out more cash but end up consuming less, hence starts to pull back in terms of the quality of consumption or quantity of consumption? So those are the things that we don't know yet. And I think that's really what Powell is alluding to. He doesn't know what the outcomes are. And to be fair to Powell, I don't think he wants to be late, but he has suggested the direction of travel for rates is lower. It's just that given the uncertainty and the things that keep moving all around, he doesn't know which way to go yet. My last point on that is pausing is not a static thing. As time passes, the economy weakens further. So your response function needs to be there. So by pausing and saying we're assessing, you are actively, perhaps, possibly weakening the economy further than you have to. So that's a point that we must be cognizant of.
In the meantime, we've seen data for the Asia-Pacific holding up pretty well, right? And we've seen central banks really kind of be able to focus more on growth in this part of the world. There are some exceptions. How much pressure is the Indian economy going to come under as we look to the RBI decision? Is there any way out in terms of that structural relationship with Russian crude?
I think, Heidi, that's perhaps the question on every Indian policymaker's mind. We probably, for context, we have to put this in place, which is the imports of Russian crude goes well beyond the net trade balance involved. It is integral to the economy because the economy needs low-cost energy to supply and broaden growth out, which is why it becomes a painful decision. that kind of informs us why India has pushed back so hard as well, rather than just conceding. But I don't think the RBI has a solution here. There are two parts that need to work. One part is because the Russian crude imports were ramped up so quickly from almost being a negligible share of India's crude imports pre-Ukraine war, it's come up to about 38%. Surely they can pare that back as a negotiation, but they might want to keep that option intact. Whereas the RBI has rightly front-loaded its cuts. Probably the best position to be is to pause right now, because the RBI doesn't want to compromise the rupee further at this point. That would just add to the stress rather than easing. So the trade-off in terms of getting some easing for the economy versus rupee instability suggests that the RBI should hold, even though they've got scope to ease a lot more. And I think that's what the RBI will stick with, especially after the 50 basis point cut where RBI shifted to neutral stance. They probably wouldn't want to backpedal on that too quickly.
At the same time, we're also watching these sort of extended conversations about an extension of the truce with China, right? Is it interesting to you that they kind of seem to be happy to kick the can down the road for what is probably the most complex of these trade and strategically competitive conversations?
I mean, it's not at all surprising. I mean, China just came out saying, I've got swag and I'm not afraid to use it. Sorry, did I say swag? I meant leverage. So clearly we saw that this is not the Trump 1.0 China who's willing to concede and say, let's get on with business as usual because we hope things will revert. This is a China that's realized there's no reversion, and there's a certain element of industrial survival and so on and so forth. So they're going to push hard, use every leverage. And I think the US now knows that there are some buttons they can't push yet, which is why there's an extension, there's further concessions, and there will be some sort of a compromise. But structurally, the US-China antagonism is not going away because in the background, we do still see tightening on chips, so on and so forth. So that we can't get distracted, but what we need to be aware of is perhaps the US will not go all out to hit China because the very near-term impact on market stability, particularly long-end yields, is not going to augur well. And the Sell America theme is something that they wouldn't want to push the envelope on too much.
China has swag. It also has a lot of liquidity along with the U.S., right? So that means the markets will be well supported. Is that a fair assumption?
I would say that the markets will be well supported, particularly given some of the optimism around the stimulus they're putting in place, backstops, so on and so forth. But let's not forget the fact that China is coming from a place of weakness. There is that property market overhang that doesn't go away. Near-term fiscal backstop to get demand going on the household end, not quite a done deal. I mean, it's a great start, but, it's a 1,000-mile journey. Baby steps are important, but they haven't concluded the game. And I think on the industrial end, China has got some edge, but needs to really keep that edge. And that's probably where I think the policy trade-offs come, because between financial stability and providing sufficient credit, that trade-off hasn't gone away. We just need to look at how the reallocation plays out as we look at China.
Vishnu, great insights. Always very candid. Vishnu Varathan, Head of Economics and Strategy at Mizuho Bank.
Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.